where he started his career is in Times Square, not as a rent boy, but as a straitjacket escape artist in the 1970s, at the same time as Robin Williams, right?
It's true. I was doing my street magic act at that time, Times Square.
And that's where he learned the art of the whole pump and dump, because you kind of fell victim to this fraud of Max was in his straitjacket, ready to do his escape, and somebody came up and stole his tip hat, and he went running down the street in his straitjacket.
And then the cops started chasing me and not the guy who had stolen my money.
That was in the 1970s when you could do that sort of thing in Times Square. You can't do that anymore there.
No.
Everything gets regulated.
That's right.
Okay, so this is our venture capital talk here at Unconfiscatable. Everybody give a round of applause, by the way, to Tone Vase for organizing an amazing event. I see no Bitcoin OGs won the $500,000 last night, though, right? No.
No.
First of all, how many people in this audience have got wrecked this past year? Okay, good, honest. Well, that's very important in the whole venture capital space. It's, I want to go over the history because it's all about wreckage and fraud. And Max Keiser was there at 2 of the 3 pivotal moments. 1946 was the first self-proclaimed venture capital firm, and it was American Research and Development Corporation, founded by Georges Doriot, a Frenchman. But from 1946 to 1981 was kind of the beginning of private equity and venture capital, and it was kind of tame and nothing too extreme. And then the first boom and bust cycle of venture capital was considered from 1982 to 1993 and was characterized by the leveraged buyout boom and junk bonds. That all ended with many people in jail, and but many new innovations in financing. The second boom and bust cycle was 1992 to 2002. Max Keiser had moved from Wall Street over to Hollywood to be part of the dot-com boom and bust that also ended in a lot of scandal and fraud and wreckage. So, Max Keiser,
Yes.
is it a coincidence that you were there and that you're there for this whole Bitcoin boom and bust cycle?
Yeah, I think I'm unique in this space because I've been involved in 4, actually, boom and bust. So there was a stock market. I started in 82. We had the crash of 87 and the entire realignment of the capital markets. I was in the dot-com boom and crash. Then don't forget there was a silver from 15 to 50 boom and crash. And now we had a crash in Bitcoin. So I've been on 4 major crashes I've experienced in my career so far. So,
So just so you know when you take that sort of advice from Max Keiser. Chase Mayer, of course, he doesn't seem to get involved in much wreckage. I would say venture capital, almost like 90% of their investments, they get wrecked. But they're counting on the 100x or 50x sort of investments that go to the moon. You seem to have all moons that you've invested in. What's your role with venture capital?
Well, in the Bitcoin space, I've got a different thesis than like Dan Moorhead or Barry Silbert and Andreessen Horowitz and some of the other guys. So their thesis is we should invest in the picks and shovels and not in the gold itself. My thesis has been, I think it's better to invest in the coin itself because it's at the core, and then like why do you hire Bitcoin? You have these 7 network effects that move out from that. So you got speculation, merchants, consumers, security or the miners, developers, financialization, and then settlement currency. And within each of those, we've got huge, almost entire industries. You know, you got like the custody industry, you got the exchange industry. That's just in the first network effect of speculation. You know, so when I'm looking at this, I'm like logically organizing it and seeing where the industry is going to be at what point in time, and like why invest in a 6 network effect company like when we're just in the first decade? I mean, it might take us a while to get there.
Tell everybody about your network effects, the various layers of it and what.
Yeah, so like speculation, you would need to be able to secure your Bitcoins in order to speculate on them, right? And that's why I funded Armory, which was core infrastructure for the entire Bitcoin community. And I mean, most of the exchanges used it for years, you know, and we're just now getting other custody solutions built for institutions and stuff like that. Well, why did I want Armory? Because we innovated cold storage, we innovated hierarchical deterministic wallets. I mean, think about it. That first wallet.dat file, you only backed up 100 private keys. Like you could go through those pretty quick, and then you think you had a backup when you didn't, and oh, there go those 1,000 bitcoins or whatever, right? So in order, so that was my thinking. Like I need to properly secure the bitcoins. I guess I'll fund Armory, so that we can split the wallet between the network consensus of Bitcoin Core and the wallet, because the wallet wasn't really getting a lot of attention in the Bitcoin Core project. And why should it? We need to focus on the network consensus there. And so that was Armory, and it has become a goose egg. We've turned it into an open source project because you don't win them all. But at least I still have Bitcoins I may have bought. They're not in Mt. Gox or whatever. And so then, after you've got Bitcoins that you can speculate on, well, now you need an exchange in order to actually speculate on that exchange price ratio, right? So I went and looked at a bunch of different exchanges. And I remember I just spent a week in New York with Charlie Shrem looking at BitInstant, and Charlie's like, "What, are you going to invest?" And I was like, "Charlie, like, we have no financial statements here. Like, you're either incompetent or you're engaged in fraud. Like, I can't invest in this. And I don't want to fund your criminal defense." And like 6 months later is when he got arrested. So I dodged a bullet there, major minefield. Winklevi had to, throw him under the bus in the press. And then, another exchange I took a look at was CoinMKT. Went and met with those guys down in Santa Monica, and one of my buddies that came with me, he does HIPAA compliant data service, so he's very much into cybersecurity. He's asking the CTO questions, and the CTO doesn't even catch the issue. So we're like, can't invest there. These guys, complete amateurs. And asked the similar type of questions to the Kraken guys, and sure enough, they like catch every ball we throw at them. So it's like, oh, these guys might know what they're doing. So we invest in Kraken. And
it sounds like you actually did due diligence. That's something that was kind of missing in 2017 and 18. We'll get.
Yeah, I mean, people think like you just get lucky, right? Yeah. Like, I find the more you work and the more you study and the harder you work, like the more lucky you get. And so far Kraken's done pretty well. We have nice EBITDA. Max is an investor over there, and then second and third network effects would be merchants and consumers. So that would be like the payment processing side of stuff. And that's all gonna have to happen on like layer 2 stuff, but you can still go out and take all the land, like be the place where, if big retail is gonna come in and accept it, like, oh, they'd come to this company. And so that would be the BitPay investment. But one thing I've found is that, even though it's all kumbaya, like when you make the investment, like sometimes, entrepreneurs have minds of their own and they go chasing after Bcash or whatever. And it's like, seriously? Like, really? Why can't we just work on building Lightning Network and like doing the work? But I guess everybody wants to feel important or something, and even when you're not. So anyways, that's kind of, what you're having to deal with is like everybody's got different vision. Everybody's kind of got their own financial incentive, and people think differently. There's asymmetric knowledge and all of this stuff. And so when it comes to venture capital and like especially open source projects, I mean, like there's nobody in charge of this thing. And when you're coming from a traditional like VC where you're trying to lock people up with like voting and board seats and all this stuff, and then like you like smash your head open on an open source project like Bitcoin and get wrecked, I mean, this is a completely different animal, I think, from any of the other previous
I think
things that we've
that's
seen.
kind of like with the SegWit. You had the butting of heads with the corporate side of Bitcoin and the developers, more or less.
Yeah, and I think what we found, because we had Bitmain, we got 90% of the hashing power, and like, oh, we got like this New York agreement, like more people that think they're important. And what happened? Like they got like the hodlers of last resort just went boom, and they just are knocked out like flat on the ground. And how many billions of dollars did they lose? Like, So you have to understand how you have to do a lot of due diligence in this industry, and it's not simple. And there's a lot of game theory and economics and all this stuff at work. And I like the Dalai Lama. I think he's got a lot of wise stuff there, and flow around, not through obstacles. Like, try to make nature and the natural flow of things like your ally instead of trying to fight against it. And so that would be another kind of premise or that I like to operate under.
So, has anybody here ever been Zao-tonged? Are you old enough to remember it? How about BitMEX wrecked? Yeah, so that's the new version of it. Max and I were sitting at a Bitcoin meetup in Hong Kong quite a few years ago when Arthur Hayes pitched us on this new idea. He was building BitMEX, and we remembered, of course, Bitcoinica and getting Zao-tonged on 10x, going 10x on your Bitcoin, and everybody got wrecked. That was in the real Wild West days, and we thought it was pretty crazy that he was going to be offering 100x on BitMEX, but it's quite successful. But BitMEX Research does some fantastic research for anybody looking to start investing in companies, or now that equity might be available again in these Bitcoin startups, now that the ICO market seems a little bit dead. But he mentions their research found that ICOs gave themselves $24 billion in tokens that they created for themselves, and they reckon that they sold at least 13 billion of it. And that's like, they're making more money than venture capitalists who are working their butts off to try to do all the due diligence and invest in these companies and helping the companies grow. And these ICO scammers, you could call, they ran off with at least 13 billion, perhaps 24 billion. Max, compare that to the .com boom and bust, that initial, like all that IPO wave where you have the similar, like, ordinary investors got totally wrecked. They lost $5 trillion in the .com bust. Can you compare it to that time?
Well, the problem with the ICOs is that they're unregistered securities. So because I started on Wall Street, that was clear to me from the beginning that these are unregistered securities and that there would be a problem with them. And so you can't really compare them because it's fraud. I mean, it's not even close to being legal.
Yeah, but at least in the .com boom and bust, like at least they had pets.com, an actual website, or they had knockknockjoke.com.
Well, you have market mania in NASDAQ in the 90s, late 90s, okay. And a lot of things went public that shouldn't have gone public. But that's a boom and bust. That's not uncommon. You see that all the time. But there's nothing fraudulent necessarily about those companies. They were not well articulated. They're not good companies. They're not ready to go public. They had no businesses to go public. But the market was demanding, more of these first day pops, as they were known, and Wall Street was pricing things way undervalued to create those pops, to create. Frank Quattroni over at Credit Suisse was involved in laddering of IPOs, and a lot of fraud was going on. But it's within the parameters of what the SEC already understands. What the Securities Act of 33 and 34 covers much of these scams that were in the 20s that led to the crash. And the crash of 29 was Wall Street scams. Led to the crash, and the Securities Act of 33 and 34, in my view, is what gave us the American century. It wasn't the lead up to World War II. It was regulated markets and formation of capital, and that's what made the U.S. the greatest capital formation entity in the world. Is the ability for entrepreneurs to have access to capital. That's what makes the U.S. a leading technological entrepreneurial country. So these scams, though, are always on the periphery. So I saw them formulate during the ICO period, and we ended up in our VC fund that we have. We don't really have any ICOs because there was no point to it. To Trace's point, there's plenty of action just owning the coin and around Bitcoin.
And they're always pushing the boundaries because, like, we saw some of these white papers, and then there was like a minimum $25,000 contribution or donation. Did you see any of these, Chase? Or
Oh, yeah, I mean, I saw plenty of them, and I mean, it's a bunch of just like white papers and buzzwords, and usually the longer the white paper, the shadier it is. So like, that's general rule of thumb. But to Max's point about like regulation and capital formation and entrepreneurial endeavor, there, having a legitimate business that has real earnings, like there's a lot of opportunity there. Like my Kraken shares, for example, they've outperformed Bitcoin by 8x. I mean, that's like a big deal. And so, there's definitely opportunity there. But like with the ICOs and all this stuff is just crazy. And now, like Caitlin Long and I and a bunch of other people, we've been working on this Wyoming custody bill. And to Max's point about capital formation and the depth of the capital markets, you have to have the legal infrastructure. There's software code and not your keys, not your coins type of thing. Like private keys give you the dominion and control, but that doesn't necessarily give you ownership. Ownership is a legal issue and a property rights issue. And so you have to have a legal regime, and you're going to be under a legal regime whether you like it or not. And currently the legal regimes, we've got things like UCC liens, and these are usually all asset liens. And now with like Genesis Trading lending on Bitcoins, pretty much every Bitcoin out there has a UCC lien on it. And guess what? The owner of that lien has a superior property right than a bona fide purchaser of the coins. So like when you go buy Bitcoin from Coinbase, you don't get clear title to it. It's probably encumbered by a lien. And those liens follow the coins indefinitely, right? And so like one of the things I specifically got put into this bill, and hopefully the bill gets passed in a couple weeks, is that we will clean these liens every 2 years as coins go through Wyoming custodians. And so, that helps clear up the clouding of the issue, of the ownership of the coins. Because if you're an ERISA fiduciary, managing pension funds, and you have unlimited personal liability for managing these billions of dollars, you can't invest in this space when you don't have legal clarity on these types of things.
Can you go a bit into that? Because I'm sure a lot of people here might be alarmed that you said if you buy a Bitcoin on Coinbase, it's encumbered by liens.
Yeah, okay, so say you're a coffee shop and you have a line of credit with the bank, and usually these lines of credit, what you would do is you would have an all-asset lien. And so all of your assets would be collateral for that loan to the bank. And people come in and they buy coffee, and some of them pay with dollars and some of them pay with Bitcoins. Well, dollars, they're super negotiable. And so under the UCC, you have super negotiable rules where a lien can't really attach to the dollar. And that's part of public policy in order to encourage like the free flow of dollars as legal tender and as money. But your coffee machine, for example, as property, the lien would attach to that. And so then if you sold that coffee machine to somebody and then declare bankruptcy, like the person who bought the coffee machine, that coffee machine is subject to this lien. And so they don't have superior title to the lien holder. They have superior title to other people, but not to the lien holder. And so then the lien holder could come and say, hey, like, I got superior title to this coffee machine, like, give it to me. And it gets seized and given to the person with the lien that has a lien because they have superior title. Well, Bitcoin is property and falls under like these all asset liens. So then the question becomes like, well, are you tracking specific UTXOs? And then what happens when those UTXOs like go into like an omnibus account like at Coinbase? Are all of the other UTXOs contaminated because of that? And a judge, of course, is going to look at that and be like, oh, well, since you can't say it's a specific one, like all of them are used to satisfy the lien because that person's got superior title. So, I mean, this becomes a problem because it becomes an attack surface and an attack vector. And it doesn't really matter when Bitcoin's like $60 billion. But if Bitcoin's $2 trillion, well, guess what? There are like an army of attorneys out there, and they're going to be like, oh, look, there's a bunch of unprotected Bitcoin. Let's go get it. Right?
So you've identified this problem, and you've worked with Caitlin Long to address this issue.
Yeah.
Have people like Backed or any of these people offering Bitcoin settled futures? Are they actually looking at that as well, or had they thought of it?
Yeah, so like LedgerX, for example, their CFTC regulated swap execution facility and derivatives clearing organization, they actually attach liens to Bitcoins every time they come in for deposits so that they can get as superior title as possible to the Bitcoins. And that's part of what the CFTC required of them. And then we see that in other, other custodians or other people are trying to perfect title on the Bitcoins. But like it's tricky because of how like the UCC and the way it's adopted and everything. And like Caitlin, she had run the pension practice at Morgan Stanley. I mean, Harvard trained attorney. She's brilliant, 20 plus years on Wall Street. And then when they were moving like all these giant pensions, she actually architected all of that. And she was on the hook. Like she was the lawyer architecting. I mean, transferring $20 billion and having it all settle in the same day so that you're not subject to like a bank failing like after. I mean, this and having to deal with all the plumbing and then like if Adam Back is Gandalf, like Caitlin's Galadriel. I mean, like it's like because lawyers, craft code. They craft legal code just like software developers craft software code. And so she knows like all of these issues and these minefields. And so we've gone in and specifically like architected this bill to help enforce property rights. Because that's ultimately what we want to do, is we want to enforce the property rights so that when you buy a Bitcoin, you actually own the Bitcoin legally. As opposed to like New York, which has made it legal to rehypothecate. Like part of our...
This has been a big story leading up to the financial disaster of 2008, 2007, 8, and 9, and which led to, Chancellor on brink of second bailout for bank, is rehypothecation. So go into what rehypothecation is.
Well, I mean, that's where you have collateral and then you have multiple people who could have legal claim on the same collateral.
So like you could take a mortgage, which is the first hypothecation, and then you could you could sell that mortgage again. But in the U.S., at least it's restricted to I think 118%.
Yeah, who knows?
But it's actually legally infinite. You could infinitely rehypothecate in London, which is why almost all those financial frauds, whether it was MF Global, a lot of Bernie Madoff scams went through London as well. So because you're allowed to infinitely, you could take the same asset and lend it to 50,000 people.
Right, and so the bank run becomes a bank run on the good collateral. Yeah. And part of having the good collateral is having perfected legal title to it. Like so, this is actually the language in the bill. Quote: a special purpose depository bank, and we're going to actually make a bank. So you can legally operate in all 50 states. And in this special purpose depository bank will be able to custody digital assets. They'll also be able to be a qualified custodian, which is under the SEC rules, which is another thing that would be essential for like an ETF, for example. A special purpose depository bank shall not authorize or permit rehypothecation of digital assets under this section, period. I think that's pretty clear, right? The bank shall not engage in any activity to use or materially affect a digital asset except based on depositor instructions, period. So like, these exchanges, like, are they running Dash masternodes? Are they like earning rewards and like voting on like projects, and that are getting funded and that's materially affecting so are they doing that with like Dash that customers have deposited onto the exchange? Like a Wyoming custodian?
Well,
you got to put it all in writing.
Yeah, you saw that issue with some exchanges were slow or reluctant to even give up the BCH or BSV to...
Oh, yeah. And what about your bite ball? Like, did you get that? Right? Yeah, and so we actually have another thing that in the bill where you have to agree in advance, in writing, on what the source code is that you use to define the digital asset, period. Any ambiguity shall be resolved in favor of the customer, period.
And has this passed yet, or
no?
You're just submitting the bill.
Yeah, Caitlin and I we're going to be meeting with the banking commissioner and maybe some other people up there next week, and then middle of February, I think that they'll be voting on it.
So when this bill
hopefully it passes.
When it passes into law, does Wyoming become the equivalent of Silicon Valley for the crypto space?
Well, I don't know what legal infrastructure like California gives this competitive advantage to Silicon Valley. I think it would be more analogous to like the credit card industry or like the
Delaware.
trust industry or like Delaware,
Right.
you know, because you have to have this legal infrastructure to then enable particular types of institutions or organizations, like a special purpose depository bank that can hold digital assets. And so then the question would become like, as a, you know, if you're in the crypto space, it's like, do you want to have a Wyoming custodian where they have to tell you exactly what the source code is that's defining a Bitcoin, like no Bitcoin Cash being the real Bitcoin, right? And they can't do anything with your private keys and voting, or like they can't use it or anything. Like they have to have written instructions from you in order to be able to use any of those assets. Or are you going to have it in New York where there's a bit license and where it's legal to rehypothecate and you don't even have any idea like what you actually own like over there, and it's not protected? Like, you know, these cowboys in Wyoming, they understand property rights, and they like those matter to them, you know, that good fences make good neighbors type of thing. And so they, you know, the Bitcoin is very binary. Like you either have the private key or you don't. And that's a very bright line property right in terms of the software code. And it's in harmony, I think, with the general culture of Wyoming. And then Wyoming, there's no state income tax, and like, you know, the trusts and all of these things, like they like to encourage that industry and LLCs. So I think this is very in harmony with like the type of business that they're trying to draw and build in Wyoming. And
So I might add
Wyoming
that
lots of
Nevada
money.
also has property rights, but it's open range. There's no fences there, and it's your responsibility as a user of the highway to not hit the cow that's walking across the highway. I swear to God, we learned this just a few months ago when we almost ran into two huge cows in the middle of the highway at 65 miles per hour. I saw all the signs, open range, warning, open range. I was like, who puts a cow in the middle of the highway, right?
Well, part of that's like 90+% of the land in Nevada is owned by the federal government.
Yeah.
And yeah, and there are whole types of problems there because like with the management of the horses, like I don't know if you follow much of it, but like the feds have made a complete mess of like how you manage the lands like out west.
Anyway, if you run into somebody's cow on the highway, it's your fault, and you have to pay for it, just so you know. So be careful.
Yeah, I
we
kn-
went 30 miles per hour the whole way. Like,
I knew somebody who knew someone that was their friend that actually hit a cow, but they had like one of those Ford trucks with the big wheels on it.
Yeah.
And so they actually killed 5 cows in one accident because they like hit the cow and it launched them up and they landed on the other ones.
that must have cost them a fortune. Oh, my God.
I think they survived, hopefully.
Oh, my God. So, Max, okay, let's go back to this whole leverage buyout phase of the 1980s that you were there, and then the dot-com boom and bust. There was a lot of, you know, everybody was pushing the envelope on, you know, things hadn't yet technically been outlawed. So Mike Milken was trying all sorts of stuff, Ivan Boesky, those guys. Same in the dot-com era. There was a kind of Wild West aspect to it. But the regulators, I mean, people like Mike Milken, who's a billionaire and friends with presidents, he went to jail. Like, he got thrown in jail. Media got a lot of, there were media fines during the dot-com bubble, all the pushing and the pumping and dumping of various shares and the you know, basically back-end deals with some of the token operators of the day. Are you surprised about the lack of any sort of enforcement actions against any of these ICOs? Like, it's widespread. It's just quite amazing that there hasn't been any pushback at all.
Well, they're taking their time because they you know they have all the time in the world really, and so you know financial innovation and financial engineering, you know, had a huge boom in the 80s, as you point out, and that was part of the whole neoliberal revolution of Reagan and Thatcher, and we're going to unleash Wall Street, and we're going to unleash financiers, and they're going to start inventing financial products. So before then, there was really only a few financial products. There were stocks and bonds and commodities and property, and that was about it. Then in the 80s, they invented tons of different variations on those themes, and the leverage buyouts under Mike Milken and Drexel Burnham became the tool of choice for corporate raiders to start taking over corporations, and they became a threat to the establishment. And so when the LBO guys started to make moves on the biggest companies in America, then Mike Milken got nabbed. and spent some time in jail on what I would argue is a technicality, and he was framed.
Process crime.
You know, he is a process crime, and he's a hero.
But tell everybody what the junk bond issuance, what was so original about that, the financial innovation on that, and whether or not we've actually seen anything with this, that, basically junk bond offerings, original junk bond offerings, the equivalent in the shitcoin market and these ICOs. Like, will that lead to any financial innovation? Do you think that's going to spark anything that's changed?
Right. So I think Milken's paper at Wharton talked about the outperformance of B-rated bonds over A-rated bonds. And so to get a B-rated bond, why wait for a company to fall in hard times and have their credit downgraded? You could just issue original B-rated bonds because the yield is higher, and there's a huge pension fund money that would put money into this. So that gave rise to Ivan Boesky and Ron Perlman and Carl Icahn,
Jimmy Goldsmith.
that whole class of corporate raiders, and they used to call it green mail, which is of course a variation on blackmail, but they've rebranded themselves as activist investors, and private equity now. So they're the good guys now. They used to be the bad guys. Now they're the good guys. So with ICOs and what we're seeing now in the coin space, it doesn't even qualify to be that level of extreme bending of the rules. It's a complete pulling out of one's butt of gaseous properties and calling that having value. There's no value at all, as far as an equity investor would be perspective. There's nothing, absolutely nothing. That's the answer. There's a wave of it's a classic Ponzi wave where you had people that Bitcoin made a move up, and now that is being leveraged to be repurposed into a never new supply of ICOs, and they're all investing in each other, and then the bubble pops and it collapses.
It was an innovation in that you got the liquidity event first before even building the company. At least these companies in the .com era, for example, had to create a website. Like, they had to do some work.
Right. The ICO was the exit.
Yeah.
Right.
And so that's why no companies got built.
Right. So you didn't need to do anything after you ICO'd, because that was
Why
the
would
exit.
you, unless
Right.
you're actually committed to building something? But as soon as somebody gives you $150 million in donations, they're calling it, like, why would you stick around, right?
Yeah. Don't tell Nancy Pelosi this, by the way.
Yeah.
Make a big thing out of it.
Yeah, and let's scare people a little bit here.
We like that.
Oh yeah, this will be a fun one. So, like, securities fraud, bankruptcy. Bankruptcy statute. It's a federal issue under the Constitution, and securities fraud. Like, you don't really get to discharge that in bankruptcy, right? Yeah. Well,
Right.
it would be against public policy, because then we'd encourage people to engage in securities fraud and declare bankruptcy. So, that's one thing. But, like, let's look at bankruptcy code for a little bit. How about Section 526C? This
guy knows everything.
Yeah.
See, Tone Vase,
Well,
thanks for getting this guy here.
yeah. Well, so 526C. This is a huge attack surface and attack vector. It's the civil contempt power. This is where a bankruptcy judge can basically, like, hold you in civil contempt, and they can put you in the pokey indefinitely. You can't really challenge your illegal detention in the pokey. And where an interesting intersection with this was with the offshore asset protection trust. So there was this guy, he got divorced, he had wired a bunch of money into this offshore asset protection trust, and the judge was like, wire the money back. And he was like, well, I'm not the trustee, I don't have the power to do that. And so the judge was like, well, I think you do, so I'm going to throw you in jail with civil contempt. That judge eventually retired, and the new judge was like, well, I don't think the coercive effect is working, so I'll let the guy out. He'd been in there 14 years. And the reasoning behind it is that he has the keys to his own jail cell, because he can wire the money back, right? And so the analogy is like, what happens when a judge thinks you've got the private keys to Bitcoins, but you don't actually? Now you're in the pokey, and he thinks you've got the keys. There's no way to prove you don't have the keys, right? And you might actually legitimately and justifiably think that you have superior title to these Bitcoins because you bought them and you paid for them and you got them from Coinbase, but they were encumbered with this UCC lien, right? So, I mean, this could get very interesting. You know, it's one of the reasons why I think it's important for us to work on the legal regime that our property right ownerships to our Bitcoins fall under. For example, like Nevada has a domestic asset protection trust, and you get assets in there, and after 2 years, it basically seasons them. And so then you can't get them out of there. And there's actually never been a case where assets have been pulled out of a domestic asset protection trust under the Nevada law. You know, so that's, you know, infrastructure that you could use. And the federal bankruptcy code has this 2-year statute of limitations, and so that was the statute of limitations that we chose to put in with the Wyoming bill. Because, I mean, obviously I would want 0 days. Like, you move it through a Wyoming custodian, like, it cleanses it. Like, that's what I would want, right? But we have to have, you know, in order to get something passed, it's got to be, like, reasonable, you know, because you got to get buy-in from all these people that are going to vote on it. But, you know, that's kind of a scary thing is you know, you look at the offshore asset protection trust and how that's been applied with bankruptcy code and civil contempt power, and then we've got key disclosure cases that have mainly focused on like criminal due process. You know, it's someone coming across the border with child porn, and it's like, oh, you have to give us the key to your fully encrypted hard drive. Well, you know, that's different. Like, that's totally different than when you're dealing with like a bankruptcy judge. You know, because these bankruptcy judges, they deal with slimy security fraudsters like all the time, and who are trying to hide their money. You know, and these bankruptcy judges just have zero tolerance for this type of behavior. You know, because they're dealing with scamsters all the time. And so, like, it's going to be very interesting to see this intersection between like criminal due process, encryption, key disclosure, bankruptcy law, and then Bitcoin and crypto assets.
Now, Jason Calcanis wrote a great piece about this when the ICO thing all started to fall apart. He was involved, you know him from the dot-com days, and he talked about the 10 years after the dot-com collapse, how all these companies, even if they had raised money in the IPO, they lost it all in legal fees fighting the lawsuits afterward. A lot of these exit scammers and ICO scammers, they think just because they called it a donation, it wasn't a securities, and they had these people who gave them the money had no claim to any equity or rights in the company. Do you think we're going to see a situation like that hampers, like basically that removes those people even from the equation, and then the next, you know, the equivalent of what we have now with the internet and the investments there? Like, do you think all those bad actors will be like fighting? They think they got away with their funds, but they actually haven't.
I mean, I could comment on that. Like, I was at the technical advisory committee meeting for the CFTC recently, and you know, after the meeting was done, we were having lunch and you know, chatting, and there were over 400 subpoenas that had gone out for these ICOs, and so that's kind of fun. Like, you haven't got your subpoena yet. If you're just wait, it's coming. And yeah, I mean, it's kind of scary because there's a principle called rescission. And so, like, when you enter into a contract and like didn't do very well, like, well, let's just rescind the contract, you know, and that's where you would give the person back all the money that you'd taken from them. Well, how do you engage in a rescission when they gave you like $1,000 and now your altcoin's like evaporated to $150? Like, you don't have the ability to basically buy yourself out of jail by engaging in the rescission. And so this is gonna be fun to watch too. You know, people getting wrecked and like taxpayers having to pay more rent for people in jail.
Yeah.
Well, from the VC perspective, I mean, you're seeing it already in some of the investments, like Kraken, for example. Or Shapeshift, their legal reserve requirements are mounting pretty high. So at Kraken, you know, they're doing a funding round to just have some war chest.
Yeah, but that's that's
Wow,
the
that's-
cost that never, like the ICOs said they didn't have those costs, essentially. They said there's no regulatory burden on them, so they didn't plan on any of that stuff. And now what I'm saying is like these ICOs, I don't know, Joe Bag of Donuts coin, like he spent a whole bunch of money on flights, private jets, and he thinks he got away with it because these people were generous in giving him donations.
Yeah, I mean, Trinidad Shavers is in jail. Like, and I interviewed Jason Siebert, his attorney, on my podcast. You know, we kind of talked about this. No, I mean, people are going to go to jail. They're in jail right now. More people are going to go to jail. Ross Ulbricht, he's got life. He lost his appeal. He's going to die in jail, unless there's a presidential pardon. But that's probably not going to happen. So, I mean, like, this is serious. And if they've got you, they've got your Bitcoins. You know, because all the hodlers, they don't mind if you die in jail because those Bitcoins just get destroyed, right? So I mean, you've got like, this is serious. Like, the law is not to be trifled with.
Right. Well, in the venture business, right? So the venture capitalist is taking on maximum risk, and in the Bitcoin crypto business, that risk is being taken on by people that are not really prepared to be taking on that risk. They shouldn't be taking on that risk. So the venture capitalist has a portfolio, and they know that eight out of 10 are going to go to zero, let's say, to get that one home run. So in this crypto business, though, that model, that incredible risk profile went out to the general population, and they're just completely unprepared for it in a lot of ways. So now they're learning about it. So what's interesting about this space is that people in it are learning about banking, central banking, technology, legal requirements, property rights. Everything comes into play. I think that's unique in that respect.
But in the 90s, during the dot-com bubble, it was ordinary investors that they were buying the IPOs, and everybody thought they were getting rich. The billions have been made on the pros, the second wave that came after all the initial fraud. So now, are we going to begin that phase of the whole Bitcoin space? Do you think we're now going to see the equivalent of all of these huge Silicon Valley VC funds that made all the money on the Ubers and the Amazons and the Facebooks?
Yeah, I think that similarly in Wall Street in the early 80s, it was like cowboys like in their 20s, like myself, and then you had the crash of 87, and then it became very corporatized. So banks started doing the mergers and equity, the leverage buyouts, and the individual corporate raider became less of a factor. In the dot-com, you had the crash. Before the crash, there were thousands of interesting projects going on. After the crash, you had the rise of 3 or 4 huge companies that gobbled up everything. So similarly in the crypto business, I think that's right. I think you'll see now this is the end of a certain phase of the romantic phase of crypto, and then we're going to see higher prices, but it's going to be much more corporate, much more institutional, a lot less fun. And we'll talk about those early days nostalgically. There'll be a movie like the one with Leonardo DiCaprio, Wolf of Wall Street. There'll be some movie like that, The Wolf of Crypto or something, and it'll be very romantic. And but
It's going to be called When Lambo.
When Lambo, and
I'm already writing it.
This period I think is over though, the fun period.
Okay.
Yeah, I mean, we've had a lot of opportunity for entrepreneurial just stuff, but those days are, there's just so much more money coming into it. Like big pension funds are trying to come in here. I mean, keep in mind the SEC, they really think they're out hunting dragons. They think they're doing God's work, like protecting people from getting screwed over by scammers. And I mean, in the U.S. government, I mean, like one of the poker guys, he was on a flight from like Mexico to Europe, and the FAA like diverted the flight to Miami and then like yanked him off the plane and threw him in jail. And like the BTCE guy, like he got extradited to the U.S. So I mean, it's a very long arm of the law. So, I think if you're honest, you have integrity, you're not engaging in fraud, that's a pretty good start to not getting yourself in trouble in this space.
Yeah, I mean, obviously, when you saw there were like 2,000, 3,000 tokens, and there are only like 20 engineers who actually know how to build any of this stuff. You were like, it didn't add up if you did even the slightest due diligence. So what do you think for the medium to long term now? What sort of investments are you looking at? It looks like maybe title insurance would be a good market.
No, I mean, like Kraken's going to do great. You know, we got a venture capital arm. That's why we're raising money. We want to do more acquisitions there. The companies that are there early and survive, I mean, they're just going to be incredibly difficult to compete against. You know, the Coinbases, the Krakens, they're locking up those markets, you know, and then they're going to be able to acquire the new talent and the new companies that are out there. So, you know, it's just going to get a lot more competitive. The barrier to entry is going up. You know, you're going to have lots of financial resources to pay attorneys and to run a real business. Like, we're not in this innovative stage with a brand new technology. Like, it's been around a decade now, and like the largest money in the world's been moving into the space.
So Max, you were also in the dot-com space when there was a metric back then to how in your case, your bank was Bear Stearns, your investment bank in your company was Bear Stearns. But the more money you were losing, the more your value was. This is their metric they used. We had similar with the ICO market. I mean, the metrics were insane, right? Do you think?
That's right. So we had a major auditor at the company on board, and the investment bank, Bear Stearns, asked them to cook the books to make it look like we were losing money faster, because that would indicate we were growing fast.
Yeah.
That was the rate of growth, was how fast you're losing money. And then they could get a huge pop on the IPO. Yeah. Right? So that was a huge crash, of course, in 2001, I guess, in NASDAQ.
So you survived that. You got out right before the crash. Again, Max
did,
always
yes.
gets out right before the crash. So if you see Max exit the Bitcoin market, time to leave. So are you staying around for another 5 to 10 years, or what do you see on the horizon?
Yeah, no, I think that, you know, we actually approach this slightly differently because it dovetails our work as journalists. And the concept of censorship resistance in Bitcoin is extremely important in the freedom of speech debate. So that's been an ongoing battle for 30 years. You know, I've been battling censorship for a long time. So Bitcoin, to me, that's what I believe. For me, its primary attribute is its censorship resistance, and it applies across the board to many things, and particularly with free speech. And so I'll be fighting this fight, continue to fight this fight.
And I see Tone Vase is ready to move on to the next segment. I do want to say, you know, having been around in this 2016, 17, 18 period, the Tone Vase and all the people on his panel, like the amount of money these guys could have made being thrown at them, that was like from these horrible scammers in that ICO space, like the integrity is really quite high here, that they would have been withstanding like millions and millions of dollars in offers for just putting their face on a poster. Like, that's the sort of money that was on offer, and they didn't take it. So it's quite remarkable that he found other